Every major crypto blowup, from DeFi liquidations to centralized lending failures, has one thing in common. It wasn't the technology. It wasn't even volatility. It was loan-to-value ratios that were too aggressive.
I think the crypto market has been limping along since October 10th, because on that date was a negative shock. But on October 10th, that liquidation was so big, Brian, it really crippled market makers. And if prices fall, they've got to then do more selling.
Today, we are explaining why LTV is the real risk lever in crypto, why retail consistently uses it wrong, and why institutions obsess over it, especially as tokenization scales. Retail crypto users tend to push LTVs as high as possible. Why? Because higher LTV means more leverage, more yield, more capital efficiency. Retail often borrows at 70%, 80%, sometimes even 90% LTV. That works in calm markets, but it leaves almost no buffer when prices move. And in crypto, prices always move. Institutions think about LTV completely differently. They don't ask, how much can I borrow? They ask, how much downside can I survive? In traditional finance, conservative LTVs are standard. 30 to 50% for volatile assets, lower for illiquid collateral. Even lower when correlations spike. Lower LTV means larger volatility buffers, fewer forced liquidations, more predictable outcomes. Institutions are willing to accept lower returns in exchange for staying solvent through stress. That mindset is what retail consistently underestimates. This is a crucial point. Liquidations don't happen because prices fall. They happen because LTV thresholds are breached. As collateral prices drop, the denominator shrinks. LTV rises automatically. Liquidation engines activate. When many users run high LTVs at the same time, price drops don't stay isolated. They turn into liquidation cascades, where forced selling pushes prices even lower, which raises LTVs further. That feedback loop is what turns volatility into crashes.
There's a lot of what they call automated processes in crypto. One of them is called ADL, okay, and that's an automatic liquidation feature that would take place if someone's account or their collateral drops in price. It's essentially like a margin call. It wiped out as that spread across other exchanges, right? Because liquidations cascade. Almost 2 million crypto accounts got wiped out, even though minutes before they were actually profitable accounts.
This is where tokenization becomes important. Institutions are not tokenizing assets to recreate retail-style DeFi leverage. They're doing it because tokenized assets are easier to value, easier to audit, easier to move, and easier to use as standardized collateral. Better collateral infrastructure allows for more accurate LTV calculations, faster margining, tighter risk controls. Tokenization doesn't mean higher leverage, it means better collateral management. When institutions tokenize assets like private credit, funds, and treasuries, they apply traditional secured lending logic on-chain. That means conservative advance rates, over-collateralization, strict margin calls, and controlled liquidations. Tokenization makes these controls more efficient, not more aggressive. This is why institutional crypto looks boring, and why boring is exactly what allows it to scale. Crypto doesn't need more leverage. It needs better risk discipline. Loan-to-value is the foundation of that discipline. If you understand LTV, you understand why retail gets liquidated, why institutions survive volatility, and why the next phase of crypto will look far more like traditional finance than most people expect. Free leverage isn't innovation. Risk management is. If you want more institutional-grade explanations of how crypto finance really works, check out the rest of our educational content on the channel. Thanks for watching.